So when you're investing in NASDAQ, a lot of times we think, man, we are tech heavy. And I guess to a point that we are, but look what's in the QQQ. Microsoft, Apple, Amazon, Tesla, NVIDIA, the Googles, the Facebook, Adobe, Netflix, PayPal, Comcast, Cisco Systems. But look at this, y'all, PepsiCo. Got Pepsi in here. Broadcom, Costco. How about that? Intel, Qualcomm, Texas Instruments, Advanced Micro Devices, Honeywell, T-Mobile, who I pay $282 to every month for my 4 stupid phones. Starbucks. We even got some communist socialist countries, companies in here. Got Charter. I guess that's still Spectrum. They provide the internet that we use here today. What else we got? Moderna. Got some medical vaccines in here. Micron Technologies, CSX Corp. That's a railroad, right? It's a railroad. What else we got here? Zoom, which we're using today. JD.com. What is that? Is that John Deere? That's not, is it? I don't know what that is. Lululemon. How about that? Marriott. Got a hotel in our queues, y'all. I mean, we got diversification. DocuSign, Synopsys, Vertex, eBay. They still out there. Monster Beverage Corp. I know Matt drinks them things. Probably like a going out of style. Matt, you drink those things? Y'all, we got ketchup. Kraft Heinz. Our old pal, what's his name? John Kerry. Is that his name? Cintas. Match Group. Look, you need looking for love in all the wrong places. O'Reilly. We got some Walgreens, some Ross. Beth, you like shopping in Ross? Beth? Electronic Arts. Got some video games. Look at all the stuff we got in here. Splunk. Skyworks. VeriSign. Sirius XM. We got Howard Stern in the house. We got the Dollar Tree, y'all. Check that out. Trip.com. And there's 102 because keep in mind there's 100, but a couple of those are doubles, like Google is 2. So that's why it's like that. Fox Corp. How about that, y'all? So we got all kind of stuff. And the cool thing is, if any of these start underperforming, they get booted out. And new up-and-comers come in. I mean, I think we got a great little fund that we're focusing on, you know? So let's say we got no signals today. So that's fine. No signals. So let's go see what the market's doing. Come here, Mr. Market. You wait. All right, let's see what this thing looks like. So what do we got? We got an AD of 125. I don't know why it's doing that now. My thing stopped like I want to. So market's up. I need to start this over, I guess. But it is what's below us and above us. Let's see. Here we go. So we had an opening 15-minute range of what? Unbelievable, you stupid thing. Y'all just doing this too. Looks like it's anyway, who cares what the market's doing? All right, let's go to our volume profile. That's where we need to be anyway. So here's our E-minis. Oh no, we were neutral to bearish. We missed it, didn't we? So now we're overbought. Overbought. So what would that be? I'm now more bearish than I was. Now this can hang out here a while. We never know, right? We've got a big old range. This could test, come up all the way into here before we punch back. But we would think in the coming days that, you know, it hangs out here and should come back. We'll see. There's nothing but bad news in the markets and keeps going up. It's just incredible. Let's say our little NQ is doing. I said, let's see how our NQ is doing. Same thing, right? So we're overbought. We would anticipate a move back into here, but Oh no, it's very bullish, so isn't it? Very bullish coming on up like that. All right, so let's look at our skew driver. Skew driver. Skew driver. Yeah. So we can either go 29 days, 31 days. Let's do 29. Looks like the skew may have gone down a little bit. Let's see. 29. I'm looking for 520. 520 is 45. 520 is 45. See that? 45. Let's see what it is at 31 days. See if it changes much. 50. Yeah, I think I'll keep it at 45. Not 45. All right, it's still hanging out there. 45. Excuse me. 16, 21. So here we are, y'all. Just hanging where we've been hanging. All right. Matt brought it up yesterday. Is this the new normal? I don't know. Just hanging out. Okay. So what does this mean? Kind of that we're bullish, right? So interestingly enough, we're kind of bearish on one of them. We're kind of bullish on one of them. We don't know. And we'll save that. And we're getting no signals here. All right, that's good. Look at this, y'all. If we hadn't done a single options trade, we'd be at $8,381. Is that not amazing? Look at there, an 8,000. 8 plus 3 is that what the hold on? Sum of P2 to P2. Well, that'll be sum of P2 to P11, Jack. We're up more than that. Change our formula. Oh no. Here's what we gotta do. All right, we'll just go plus. Y'all may have to change y'all's too. Plus P2 plus P11. How about that? Now, there we go. Now we're up $8,787. That'll be those two combined. Look at us, y'all. Machine. We are a stinking machine. All right. But we can't ever think that our butt don't stink, right? I can't ever stand people like that. Everybody needs to take a bath. So let's see what we got going on there. Let's look at our overall grades. See how we do. So we are positive deltas, we're positive theta, and we're slightly negative vega, and we are up $546 on the day. Where's that money coming from? Well, it's coming from our TQs, aren't it? $604 up there. Our micros are up a little bit. Our ES is down, and we expect that to be the case when the market's up. Our SPY down a little bit, and our VIX is up a little bit for the day, and our TMF is up a little bit for the day. So that's good. So what do we do now? So I like my Greeks, right? My Greeks are fine. So the market is up on the day. So what is there to do, Bob? Oh, Bobby, oh, pal? Not a lot, really. Let's see. Let's go back into our groups. See how everything's doing. Got a complete black swan hedge here, down 225. That's all right. Let's look at our working orders first. Look at that, y'all. We're getting close to filling it, aren't we? I mean, these have been decaying quite nicely. Remember, this was like $3. Now it's $1.95. So once these two things happen, our hedge will be much stronger as we buy longs and sell or harvest our shorts. So that's good. So these calendars, though, yeah, that's the deal. And some of these are about to expire. 31, 3. What is that giving me? It's giving me negative deltas. It's giving me negative theta, which I don't like. And it's giving me positive vega. There's anything to do there, really. Our 111 trades, the best thing we got on the board. So that one's up 40. BSH is down. Micro BSH that we put on is down. Our 111 is up. 111 is up. 111 is up because that's all that one does, right? Here's another SPY calendar. 3 days, 31. Let's see. 111 23rd up. Here's the one that is missing a leg. It says it's up $1,200. I could find that leg maybe somewhere. BSH down a little bit. 111 16th up $164. That is the greatest trade. The 111, just really good. That calendar is, look at there, I got 1 day left on that short, but that's at 99% profit. So what do? Right? Well, I'll probably just let that expire. Then I'll decide if I need to keep this long on or not. So we'll let that expire. See what else we got. 111 after the harvest. 111 20th. 135, but looks like that's an after harvest too, or it doesn't have the short in there one. Let's see. Covered calls. $18 on that. Not too bad. 111 18th up $200. BSH 14th down a little bit. Dub bonds up $314. 111 doing what 111s do. That's what I wish we had more down days, man. So we put more of those on. BSH 12 down a bit. 111 up like 111s do. 111 22nd up. 111 24th up. The Q Empire is only up $7,356 on our open trades. Crazy, up 645 today. That's why I like this, man. It just gives us some big old movements. Big old movements. 111 doing what 111s do. 111 doing what 111s do. The diagonal. Let's see what I got in here. It's just 5 loans. After harvest, really don't watch those, just let them expire. BSH 10. Yeah, that's after harvest. I should relabel that. The Frankenstein, I forgot what I got in here now. It's just got the 5, so we know that's going to show losses. Fix hedge, yeah, look at there. We've lost $1,100 for that this year. Unbelievable. And it's time to put another one on, but I don't think I'm going to do it today. So we're up $500 something on the day. All right, everything looks good. So I'm trying to think, is there anything to do? I don't think so. As long as my, I'm just glad I got positive theta because I don't want my negative theta on some of these trades to weigh me down. So I try to keep that positive. We try to keep the Vega manageable. And we know we're going to be positive deltas as long as we got our TQQs in the oven. So there's really nothing I need to do. Sorry to waste y'all's time. Here we go. Let's just check our stuff. Let's see our little heads, see if we're doing good. Isn't that good though? We don't have to do a lot, right? Working the grind. You got to go to the bathroom, look at your little thingamajig, see if you're doing well. 16 here. All right, so let's see how do I do this. Hide simulations. We will go single symbol. We'll do fall step 15. There we go. So on a 20% down move, we are up $88,000, 89,000. Ta-da! Then you got to check your whole portfolio, right? You want to make sure you're okay. Everything goes down. So we're down, $7,000 on a 20% down move. So that's not bad, right? It's not bad. Now, another thing that we could do, I guess one thing that we could do is we could do another micro black swan hedge, right, to pick that up a little bit. Let's see how much hedge power we get from our little micro black swan hedge. Let's see. Come back over here. We'll put things in groups. What's this? This is how you do it, right? Show groups. Then you can analyze one of your group trades, right? So then you can go high simulation, all groups, and then we got our little black swan hedge, micro black swan hedge. Here it is. Ta-da! So it says it'd be up $262 on a 20% down move, but that does not take into effect volatility. So on that little bitty thing that we paid, what, $50 for? It gives us $2,400 in up movement if we have a 20% down move. So that's money well spent. Do I want to spend another $30, $50 to pump that up today? Really? But at the same time, I don't think that skew is telling us that we're going to have a big drop anyway. So, I'm not kind of indifferent, but we can show you how it looks, right? If you want to put a little hedge on. So sometimes it's okay to put on a black swan hedge. if the market's up. You know, you're saying I'm up $500. Let's take some of those winnings and invest it in a hedge. So we would like to go past 60 days. So there's 66. Let's see what we could do with the 3.5. You see where I've already done one, right? So here I could go sell these for 305, sell 3 of those. Sell 3 of those. And hit your control key down. And buy 5 of those. So that would cost me $37. Zero buying power. Max profit $29,000. Max loss $775. Seems weird, doesn't it? Rejected, illegal price. Oh, okay. You know, then why? Here's the thing. Why give me the price then? Why don't y'all fix that? That's crazy. So we got to make this like 525. There we go. So we sold that for 525. So let's go put it in a little bitty group. Micro BSH2. Micro BSH2. Micro BSH2. Now let's go see what that looks like. Micro BSH2. So it gives us a little negative delta, gives us a little negative theta, gives us positive theta, which is kind of sweet. So now we can go analyze that trade. So we can go instead of all groups, we could go BSH2, fall step 15, see what that little thing gets us on a 20% down move. So this will be up, yeah, about the same thing, right? Is that up 2,700? So that's how you kind of do little bitty, you know, little bitty black swan hedges, baby hedges. You know, on a day that you're up $500 or $600, you know, it's okay to use $37, $40 to put a little bit in that to boost your hedge up. So that's what we did. All right, questions on the black swan hedge? Anything at all? All right, since that's the only trade I think we need to do today, I don't think there's anything else. I guess I could do one over here. We're at $515 in this account. So I guess I could do one over here too, couldn't I? Little old Bob, little old Bobby old pal, old Pally old pal. Let's see. So we'll go out. Oh my gosh. Stuff ad. No options available for this symbol. The crap. 66 days. Put me on one over here. Come on, Bobby old pal. So we like going to $3. So we sell 3 of those. Bumping. 3 of those. See if we can get 310 out of there. 315. How about that at the meter? No, Jack's book. All right, so let's buy 5 of these. 2, 5. So if I work that down to 290, 285. Nothing. Jack squat crap. All right, so let's do these. Replace order. So let's go. Let's see. We're trying to get 315. So we'll get 310. Let's try that. Try 305. That ought to fill us there. Ta-da! All right, and then I'm just trying to be cheap, y'all. That's all it is. So we got filled there. I'm gonna pay a little more for this one. So let's pay $290. Ta-da! So now we got us a little 3.5 there. We got us a little 3.5 there. That's sweet. Analysis. All right. Ta-da! That is it, y'all. That's all we got to do. So why, since we do have a little bit of time, that's okay with y'all, I'm going to show y'all that video. Or you can watch it on your own, but I think it's really, really informative. So let's go back. share this. This dude, I think, gets it. This guy gets what we're doing here.
I'm going to show you how you can get rich by investing in leveraged ETFs. A lot of people don't.
Now, admittedly, look, this is a little cheesy, right? I'm going to show you how we get rich. We are not that person, right? We don't ever get on here and go, hey, man, let me tell you something. We're fixing, I mean, we're really proud of what we've done. We put together a strategy, but we're not trying to trick people to, I'm not saying that's what he's doing, but, he wants views on his thing, and we're giving him views, I guess. But I just hate being that person that goes, "Hey, we're going to get rich, and you can." That's just not us. That's not the way we fly, right? We're a little more reserved. But still, this is going to be a good video for y'all to watch. So I digress. Let me shut up.
Don't know this, but $16.44 per day are all it takes to become a millionaire. I'm about to share with you the secret to making money in a simple way that will change your life forever. You don't need a lot of money or experience. You can get started with just $1. You're undoubtedly wondering how it's so easy. Well, people, we're talking about leveraged ETFs. We'll go through several examples, step by step, of how it's done. You might be thinking, how? Well, let me tell you. To get started, you'll need to open an online brokerage account. There are several different brokerages and account types to choose from, so you'll need to research several of them until you discover one that is suitable for your needs. I propose taking a closer look at one of the brokers in this list, since they provide access to a variety of levered ETFs and features that set them apart from the competition. There are two main types of accounts to consider. One is a margin account, while the other is a cash account. A margin account is preferable, but an IRA cash account is typically the superior option if you're planning for retirement. After you decided on an account type to open and completed the application procedure, deposit funds into your new brokerage account, which will take a couple of days to settle. While you wait for your funds to clear, familiarize yourself with your broker's desktop, mobile, and web trading platforms so you don't make costly mistakes when you're ready to place trades. And once your cash arrives, you're ready to go. It's worth noting that we won't be covering what a leveraged ETF is or how it works. If you'd like to learn more about them, I'd cover them in greater detail in these videos, so after you watch this video, check those out to learn more. Now, let's go through the levered ETFs we'll be using to create those millions. There are numerous options, but we'll focus on those with the greatest long-term growth potential, broad diversification, reduced costs, and less risk. Another thing to consider when picking leveraged ETFs is liquidity, so that leaves us with far fewer choices. We'll start with the double leveraged ETFs that track the S&P 500 and NASDAQ 100. The S&P 500 and the NASDAQ 100 are the two most widely recognized market indexes that fulfill our criteria, and they'll be used as the foundations for our levered ETFs. Several leveraged ETFs track the S&P 500 and NASDAQ 100 in some form, but only a select few of them satisfy our requirements. We'll cover those options now. The first is the ProShares Ultra S&P 500 Bull 2X NYSE symbol SSO, which is a well-diversified and low-cost option. It's an ultra-bullish position since each share is designed to return 2 times the daily performance on a percentage basis of the S&P 500. Second is the ProShares Ultra QQQ NASDAQ 100 Bull 2X NYSE symbol QLD, covering the non-bank tech sector and being very liquid. It's also an ultra-bullish position, since it seeks a return that is 2 times the daily return of its underlying benchmark, the NASDAQ 100. Now that we've determined what double-levered ETFs we'll be utilizing, let's look at triple-levered ETFs.
I remember that day with my dad so well. He came in my room one morning and said, "I did it."
ETFs. The ProShares Ultra Pro QQQ NASDAQ 100 Bull 3X is our first triple-leveraged ETF, which tracks the non-bank NASDAQ 100 NYSE symbol TQQQ. This triple-leveraged ETF, like the ProShares Ultra 2X version, follows the underlying benchmark for a single day. The ProShares Ultra Pro S&P 500 Bull 3X NYSE symbol UPRO is the last triple-leveraged ETF we'll be adding. It too satisfies all of the criteria we established above. So, now that we've verified which leveraged index fund ETFs meet our requirements and have the most potential over other leveraged ETFs, let's get to what you came for, the secret to making money in a simple way that will revolutionize your financial life. And like I said before, You can start with little money and no prior knowledge. So far, we've looked at how to get started by creating a brokerage account, which major market indexes to target, and which 2x and 3x leveraged ETFs to use. Now, let's look at some figures. How much money could you make investing in large market index fund leveraged ETFs versus non-leveraged? And how can you two become a rich millionaire faster than you think? The first thing to keep in mind when utilizing any of these methods I'm going to share with you is your risk tolerance. Any of these leveraged index fund ETFs might potentially destroy your entire investment under the right market conditions, especially the triple leveraged ETFs, which makes these very high-risk investments for any investor. However, the most popular approach for most investors is the well-known buy and hold strategy. You may follow this approach by purchasing a large index fund, such as the S&P 500 or the NASDAQ 100, and holding it until retirement or a later date. Let's look at an example of this from the performance graph you see in front of you. The beginning period of the investment was picked because it provides the best representation of buying low and, when extrapolated into the future, shows us the greatest measure of performance. This graph reveals how much money you'd make if you invested $10,000 in each ETF and kept it for about 11 years. In red is the SPY ETF, and in blue is the ProShares Ultra S&P 500 2x leveraged ETF SSO. Would it be realistic to buy at those prices? Yes, provided you had the funds to invest and decided to purchase at that time. I cherry-picked this period for a reason. Don't worry though, I'll compare the findings to the absolute worst time to buy later. You may be shocked. As you can see in front of you, the massive outperformance of the double-leveraged SSO ETF over buying the SPY ETF is obvious. The SSO returned more than 4 times the SPY, not the 2 times you might expect. That's what happens when you couple leverage with a persistent, continuous rise in price that is trending higher. Leveraged exchange-traded funds are complicated, and the math behind them is beyond the scope of this video, but you can see how it might help you in this scenario. This is where the media frequently depicts volatility decay and beta slippage incorrectly. With SSO returns dwarfing those of the SPY, you have to stomach a max drawdown of nearly 41%. Do you think it's worth the risk? That is a question only you can answer, since everyone's risk tolerance is different. Let me know in comments. But before investing in leveraged index fund ETFs, you should think about this. Do you have a firm grip on your emotional connection to money? And are you able to disregard the volatility that comes baked in with these leveraged ETFs? Stop here if you answered no. You have no business investing in leveraged ETFs and should look to invest in more conservative investments that match your risk tolerance. If you responded yes, continue watching to learn more, because things start to get interesting. Let's pick up the pace a little and go deeper into the leveraged index fund ETF investment rabbit hole for those wanting to learn how to get rich more quickly. All right, I think you can see for yourself in this example how well SSO outperformed the SPY ETF by a wide margin. Leveraged index fund ETFs are demonstrating how effective they are in increasing returns. We only started to scratch the surface. We haven't yet made millions of dollars, so let's keep going. Now we're getting closer. In this example, if you invested $25,000 instead of $10,000, you now have over $800,000. Not too shabby, but there's more. Now I'm going to demonstrate to you a very powerful technique that you've undoubtedly heard about before, but it's quite effective. It's known as dollar cost averaging. Not only does it reduce risk, but it also boosts return. I'm not going to discuss dollar cost averaging in detail here, but I'll show you just how much it affects risk and returns. My guess is that you wouldn't be unhappy with a return of more than 4 times the SPY ETF. It's certainly nothing to sneeze at, and you accomplished it in about 11 years without putting any effort into it. It's much easier to let your money work for you than you work for your money. You can see why compounding returns are frequently referred to as the 8th wonder of the world. In this example, what if you started with $10,000 and increased your SSO investment by $16.44 each day? This isn't much at all. Almost anybody should be able to do this. Why $16.44? What makes that amount of money so unique? It turns out that if you invest $16.44 each day of the year, it adds up to approximately $6,000 a year, which is presently the maximum IRA contribution. If you're fortunate and age 50 or older, you may contribute up to $7,000 per year. Look at what that does to your total return. You're so close to those $1 million I spoke about, and all you had to do is add $16.44 each day to your SSO investment. Your total return now exceeds that of the SPY by over $550,000. If you're a young adult or struggling to find the money to add to your investment, don't hesitate to watch my video on passive income. In that video, I share plenty of legit ideas to make that extra money you need and more. You can't afford to miss this opportunity. We'll now shift gears and invest in QLD.
Hey everyone, this is John from Simpler Trading. So I'm finishing up today and I just want to show you how I'm doing this year. Here we can
QLD, the NASDAQ 100 Double Leveraged Index Fund ETF we previously discussed, rather than SSO. Bingo! Look at what you made. You made over $1 million without increasing your initial investment, and with only a 34% max drawdown. That's far better than you would have guessed. Your total return was over $1 million greater than that of the QQQ, but your max drawdown has only doubled. Impressive. It's fascinating how much can change with a simple change of the asset. Look at what happens if you invest $25,000 instead of $10,000. Look at how much money you've made. You would have made over $3 million with a very nice compounded annual growth rate of 46%, getting you to multi-millionaire status. See just how easy that was. By starting with more money sooner, you were able to create bigger gains and get rich faster. Now, let's add $16.44 per day, $500 per month. That is fantastic. By adding a few dollars each month, you increased your total return by more than $1.4 million, and the compounded annual growth rate was improved by 4%. Let's not forget the very manageable max drawdown of 34%. As you could see in this case, if you invested $25,000 in the double-leveraged ETF QLD and added $16.44 each month to that investment, you would now be a multimillionaire rather than just a millionaire. You did this without any prior knowledge of leveraged ETFs, just like I said you could. You could simply end it here, cash in your chips, and declare victory. You're a multimillionaire, and you easily beat the goal of becoming a millionaire. But why stop there? I haven't yet revealed to you what's possible with triple leveraged index fund ETFs, the significant risks that go along with investing in leveraged ETFs, or shared a few extra techniques to significantly reduce your risk, which I'll get into shortly. You don't want to miss that. Okay, just as I promised. Here are the results for investing $25,000 into the triple leverage UPRO ETF. Your total return increased by $900,000 over your double leveraged SSO investment. However, that comes with a 19% increase in maximum drawdown over the 41% max drawdown you had with SSO. So, it's not all rainbows and unicorns, despite your ability to reach millionaire status. By adding $16.44 per day to your investment in UPRO, you've had yourself up to $2.4 million, making you a multimillionaire while increasing your compounded annual growth rate by 6%. Nice. Okay, shifting gears one more time. Here's what you'd get if you invested $25,000 in the triple leveraged TQQQ ETF with no added investment. This is a stunning difference in investment returns when compared to the same investment you would have made with UPRO. Your modest $25,000 investment would have grown to over $5 million in 11 short years. Not to mention that your max drawdown would be smaller than the UPRO investment by 11%, but over 4 times greater return. This also resulted in a stunning 60% compounded annual growth rate. Let's not forget to add $16.44 per day to the portfolio. By doing this, your total return would be over $7 million, with a staggering 65% compounded growth rate and a total return of over 13 times the benchmark QQQ. Not the 3x you might be led to believe. But wait, what about those of you starting with only $1? How much money could you make from such a little sum of money? Let's find out. If you started with only $1 and invested $16.44 each day, or $500 every month, you would have made over $500,000 investing in the SSO with a respectable max drawdown of 40%. The compound annual growth rate is off the charts at 182%. What if instead you put your money into the double-leveraged QLD ETF and added $500 per month to it? You would have made over $1.3 million and a compounded annual growth rate of 204%, with a max drawdown of just 33%. Here's another example. Look at this chart from the triple-leveraged TQQQ ETF. If you began with $1 and invested $500 each month, you would be a multimillionaire with over $2.2 million in profits. Not to mention the staggering 263% compounded annual growth rate and modest max drawdown of 49% when looking at the excellent return for that risk. With these examples, I just proved it. If you start with only $1 and invest $16.44 a day to some leveraged index fund ETFs, you can become a millionaire as promised and even exceed that by becoming a multimillionaire. It's truly remarkable what buying leveraged index fund ETFs can do to your returns. This also demonstrates the significant impact compounding has on your results. But there's always a dark side to this outstanding performance. You knew it was coming. Do you recall the adage? It's just not that simple. There must be a catch. Well, yes and no. To begin, leveraged ETFs are only meant to match the daily return of their benchmark multiplied by their leverage ratio, such as 2x or 3x. For example, if the underlying index drops by 2% in a day, the 2x leveraged ETF will fall by 4%, and the 3x leveraged ETF will drop by 6% in response. Here's the catch. You need 3 ingredients to be successful with leveraged ETFs. Without one of them, this wouldn't work, and that's the consistent, persistent path of higher prices. Without all 3 ingredients, investing in leveraged index fund ETFs can quite possibly be a loser, and a big one at that. This is called path dependency. So it's critical to remember that leveraged ETFs need 3 things to succeed if holding them for the long term. If the underlying index on which the leveraged ETF is based goes up and down for lengthy periods or stagnant for an extended period, volatility drag and beta slippage are likely to rear their ugly head, in essence, hurting returns. The first is that price rises. The second is price momentum, persistence, in the same direction, and the third is price consistently trending higher. When any of these 3 criteria aren't met, returns may be tough to obtain and fall short of the underlying asset's performance. It's also important to remember that interest rates have a significant influence on the cost of leverage, which has an impact on their performance. It's beyond the scope of this video to go any further into the topic, but it's vital to recognize their Achilles heel. The unique benefit of leveraged ETFs, strangely enough, is that they may profit from these characteristics, as you've seen through many examples today. Rather than the 2x and 3x daily returns that they're recognized for, if kept for longer periods, they may produce 5x, 8x, 13x, and even more return on their leverage ratios, as has been demonstrated. Because of this, many investors have a love-hate connection with levered ETFs.
Oh, I hope plunging means up and 75 means 200.
They are volatile in their price action and investment returns. It takes more than merely buying and holding them for lengthy periods and hoping for the best. I've shared with you several examples of return performance that buy and hold investing with these leveraged ETFs has been able to attain. I won't go further into this approach because you've already seen the real-world possibilities for that kind of investing. If you would like to see more on the buy and hold investment approach with leveraged ETFs, check out these videos. Because the future is rarely like the past, you must take a more tactical approach to invest to have success with these leveraged behemoths and have ways to minimize risk. Now, I'll show you how to take leveraged index fund ETF investing to the next level by sharing some helpful strategies. This first strategy I'm going to share was discussed in these videos, but I'm going to go more in-depth here and give additional approaches and solutions to enhance profits while lowering the risk even further. They can make dramatic improvements to the buy and hold method of investing.
I'm up about 116,000. It's given me the freedom and flexibility to work from home.
More on that soon. The first investment strategy we'll look at is a risk-on, risk-off approach that tells us when to be invested and not to be. This is known as a regime switching technique. It's simple to implement, lowering your risk while also boosting your return. To follow this strategy, create a chart like the one in front of you with your broker's trading platform. Simply open a new chart, type the symbol for the leveraged index fund ETF you intend to trade, and set its time frame to monthly prices using conventional candlesticks or bars. Avoid using Heikin-Ashi-style bars or candlesticks. They don't work for this method. Each bar or candlestick on the chart represents 1 month of price movement with the high, low, close, and open prices for that month. This method uses the close price only. After setting your chart up correctly, apply a 10-period simple moving average to your chart. This will act as the line in the sand, if you will, for deciding when to take a risk-on approach and when not to. The way it works is simple. On the final trading day of each month, if your money is sitting in a cash position and the leveraged index fund ETF's monthly closing price is greater than its 10-month simple moving average, buy and hold it. If the monthly closing price is lower than its 10-month simple moving average, close the position and go to cash. It's that easy. However, if you're just starting and establishing a long new position in the leveraged index fund ETFs shown on your chart, keep in mind that the price may be near or well above the 10-month simple moving average. You alone must decide if and when you apply the strategy. We'll now look at what happens if you don't catch the market at the best time and apply the new regime switching technique I outlined above, as well as compare it to a buy and hold strategy and use it on another period. Let's see what happens. In the prior investment examples, we utilized the ideal time to buy and hold leveraged index fund ETFs. The results and performance statistics were stellar. If you had followed some of those examples in real time, you would have become a multi-millionaire many times over, within just 10 years. I wanted to demonstrate what was possible. These were hypothetical outcomes, but anybody could have accomplished this, simply by having a little bit of money, the right mindset, bought in, and held on for dear life no matter the risk. But we also can't forget this was done during the biggest bull market in history. So you are likely seeing the very best possible outcomes. Now, I'm going to show you what happens if you invest your money at the top of a multi-year investing cycle, including the dot-com crash and years later. This will give you a more realistic idea of what you might expect going forward. And like your mom may have told you, past performance is no guarantee of future results. So, looking at this example, the regime switching strategy has outperformed the buy and hold strategy by a massive margin, while reducing drawdown. By investing in 2x leveraged ETF SSO, the total return would be more than 2 times greater than the buy and hold method. Your total return of $200,000 would have crushed the buy and hold return of only $84,000. It also had a far lower max drawdown of 32% versus the 79% the average investor would have received with the buy and hold approach. You can see the results are more dramatic when using the double leveraged ETF QLD. The total return is over 4 times that of the buy and hold approach. The drawdown of 62% is significant, but it's far better than the devastating blow you would have taken with a 98% drawdown with the buy and hold method. You'll also see that in contrast, taking the path of buying and holding would have been a long road to recovery with a 20-year wait before you saw break even. That's a great example of volatility decay or beta slippage working against you rather than for you, as I demonstrated earlier. As you're beginning to see, complex leveraged ETFs, strategy and timeliness have a significant impact on returns. The stock market is a ruthless place, and timing the market is challenging at best. Having a tried and true strategy to your advantage is your only hope for beating the market. If you don't have either, your portfolio isn't going to be partying like it's 1999 or any other year for that matter. Moving on to triple leverage index fund ETF results, look at this chart of UPRO. Your total return with your original $10,000 investment was over $500,000 if you had added no further money. The upside return was 6 times greater than the buy and hold method, but with a max drawdown of 45%, which is significantly lower than the 94% drawdown for the buy and hold strategy. You'll note that I've included the logarithmic graph to show you how well the regime switching method worked in avoiding the majority of the 2000 to 2002 dot-com crash and 2007 to 2009 Great Recession bear markets, with less than half the max drawdown risk. That approach alone resulted in a gain of $500,000. In this TQQQ example, the unbelievable 53 times return advantage for the risk-on, risk-off technique over purchasing and holding TQQQ reveals the power of this simple regime switching technique. This example shows in a dramatic fashion how the leverage ratio, the 3 times leveraged TQQQ ETF, is affected by volatility decay. In this instance, you can see what would have happened to you if you had bought and held TQQQ from the top of the 2000 dot-com bull run without adding any new money to your original $10,000 investment. After nearly 22 years, you would still be underwater with roughly 50% of your original investment. Not only that, but you nearly had all your money swallowed whole by an anaconda snake, born at birth as beta slippage, nicknamed beta. That's what can happen when you invest in 3x or 2x leveraged index fund ETFs for the long term without dollar cost averaging or using a proven investment strategy. As you can see, this regime switching approach is a fantastic method for smaller investors to profit from double or triple levered index fund ETFs while limiting their risk by following this strategy. But even with this approach, there's still a wide range of potential outcomes based on how long you hold each position, which we'll discuss further. Ask yourself, are we currently at a peak in the stock market? Maybe, maybe not, but you do know what will happen to you and your money if it's true. Without a strategy in place and dollar cost averaging to reduce risk or improve return, it won't be rainbows and unicorns for you. There is a limit to how much risk one can take before it's too dangerous for most, and I believe it's somewhere between 2 and 3 times leverage. But as I've shown, there is light at the end of this tunnel. There are several ways to limit the chance of ruin, reduce risk, and potentially increase returns by investing in leveraged index fund ETFs. From complex to simple, there are many options. We'll go through a few simple methods and later.
Soaring prices, mass shortages. What's next? Hi, I'm Chris
Reveal what's possible. Okay, so you've made it this far, and I've kept my promises to you. I've shown you how to get rich and retire by investing in leveraged ETFs. I've also shown you how to do it, beginning with only $1. I also proved to you that investing $16.44 each day can make you a millionaire. But did you want better by exceeding that and achieving multi-millionaire status, which I showed is possible even if you have no experience. But now, let's go up a few notches higher and find out what's possible when you combine a multi-year bull-bear cycle with dollar cost averaging, regime switching, and later even more techniques for becoming the ultimate leveraged index fund ETF investor. Some of the approaches I'm going to discuss may be found in bits and pieces throughout these videos. I recommend that you watch them after you've finished here so you don't miss anything. This first example assumes you invested $10,000 into SSO using the regime switching technique and utilized dollar cost averaging of $16.44 per day, equivalent to $500 per month. As you can see, your overall results would have been considerably better, while simultaneously lowering your risk. Your total return with the double leveraged SSO is now $1.5 million, with a big jump in compounded annual growth rate and a slightly reduced max drawdown. By doing this, you've added over $1.3 million to your return simply by adding just $16.44 each day to your original investment. The buy and hold strategy, on the other hand, would have slightly outperformed this technique, but with a large drawdown of 74% that would terrify practically anybody with a working brain. This chart compares the double-leveraged QLD ETF performance to that of a buy and hold approach, using the same risk-on, risk-off investing method and dollar cost averaging as in the previous example. Notice the dramatic difference dollar cost averaging made in this case. The total return for the risk-on, risk-off strategy was over 10 times that of the same method without using dollar cost averaging. It also brought down the max drawdown by a fair amount, making this risk-on, risk-off technique a very viable option when coupled with dollar cost averaging. But buy and hold was even more amazing. It generated a whopping 132 times its non-dollar cost average version. The break-even period was shortened from 20 years to 3 years as well. It was no slouch in cutting the max drawdown either. It reduced the number from a mind-numbing 98% to a lesser 79%. Still very high for most people, but considering the $5 million in profit over the other strategy, it may be worth the risk to some. This example demonstrates how dollar cost averaging can be very powerful in terms of increasing returns and lowering risk. We'll now move to the deep end of the pool of high risk with the results for both triple leveraged ETFs UPRO and TQQQ. By the way, if you're happy with the risks and returns I've shared with you up to this point, using the regime switching approach with double leveraged ETFs, I propose stopping here. I think you can be quite satisfied with what I showed you so far and call it a day. However, if you want to learn about a few more advanced methods that can show you how to create life-changing amounts of money, then stick around. The first example from the high-risk deep end of the pool is UPRO. By investing $10,000 in this triple leveraged ETF using the regime switching strategy and adding $16.44 per day, equal to $500 per month, you would make a total return of $3.4 million, not too shabby. and you're able to do it with a very reasonable max drawdown of 45%, plus get a 31% compounded annual growth rate. What's there not to like? Although buying and holding performed well, the bravest of investor gladiators would find it tough to take a punch in the gut with a max drawdown of 90%. Now, let's take a look at our next ETF. The second choice, triple leveraged TQQQ, has a very interesting looking outcome. Look at the massive outperformance of the buy and hold method, over $12 million more than our regime switching model. That is off the charts life-changing money for most anybody. The $5 million from the regime switching alternative is adequate, but it isn't enough to compensate for the buy and hold strategy in this situation. But wait, how about the max drawdown that comes with those $17 million? It's a heart-stopping, gut-wrenching 93%. It would be nearly 100% without dollar cost averaging. No sane person with a half brain would embark on a kamikaze investing mission like that, regardless of their risk level. As a result, that buy and hold strategy is a non-starter. If you try, caveat emptor. I'm now going to show you an advanced method of increasing risk-adjusted returns using the regime switching strategy, but with a twist. Instead of going to cash when the closing price of the leveraged index fund ETF closes below the 10-month simple moving average, the cash will be used to buy a bond position. Not any bond position though. It's the Direction Daily 20-plus year Treasury Bull 3X shares NYSE symbol TMF. Because each share is meant to return 3 times the daily performance on a percentage basis of the ICE US Treasury 20-plus year bond index, it's considered an ultra-bullish position. Why replace cash with a bond position? That's because it has a negative correlation with the S&P 500. Correlation is a statistic that measures the degree to which two variables move about each other. To better understand it, it implies that when the S&P 500 rises in value, the bond ETF price should drop. This is in an ideal world, but under certain market conditions, they may become increasingly closer in correlation. However, as opposed to the stock market, it represents a risk-off asset or safety position as opposed to a risk-on position. So, by replacing cash with the triple-leveraged TMF bond ETF, the regime switching strategy has another opportunity to make money during challenging times for the stock market instead of sitting in cash. You also boosted your compound annual growth rate to 35%. However, this did raise your overall max drawdown to 55%, although your risk-adjusted return improved somewhat. So by investing in UPRO using the regime switching technique and investing in TMF during risk-off phases, rather than keeping cash, you were able to improve your total return from $3.4 million to over $7 million by putting $10,000 into UPRO and adding $16.44 daily or $500 per month. While a 55% max drawdown may appear to be significant, it's quite acceptable in terms of risk versus reward. Without dollar cost averaging, the same period saw a 51% maximum drawdown in the non-leveraged SPY ETF and a 45% loss with dollar cost averaging. There's no comparison in terms of overall returns, so the comparable risk may well be worth it. You be the judge. The chart in front of you now is the TQQQ ETF. You can see how much better the regime switching strategy performed when a cash position was replaced with TMF, as shown by the total return for this approach exploding. The total return increased from about $5 million to $12 million, more than doubling the strategy with cash as a safety position. The max drawdown was 67%, and the risk-adjusted return also improved. You're probably wondering at this point if you have the guts or the risk tolerance needed to follow any of these methods. And you're right to be thinking that. It's one thing to see all these fantastic gains being made in front of you, and most imagine themselves being armed with this knowledge, getting started right away so they can make their millions. However, there's another essential aspect to investing that isn't often discussed, and that is knowing yourself and your risk tolerance, as well as how you'd react if the market went into a tailspin. This is a critical fact to know before embarking on an investing adventure like the ones I shared with you today. But I do have a fantastic approach to bring any one of these investing strategies down to manageable risk levels while still sleeping well at night, and the way to do it is to limit your exposure to them. You may accomplish this by combining a small percentage of your total portfolio into one or a combination of these leveraged ETFs as I illustrated. It's up to you and your risk tolerance, but many people prefer to put only 10% of their money or less into one of these high-risk investment techniques. Remember, the more percentage of your money you put into these leveraged index fund ETFs, the greater the risk you are taking, which might result in enormous drawdowns. So be careful. Okay, so I've shown you how to generate life-changing money in the stock market by utilizing leveraged index fund ETFs, using a tried and true approach to increasing returns and lowering risk, as you saw and understood here today. But it doesn't stop there. I'd like to add one more approach, since most individuals will look at the techniques I outlined and may decide that they're too risky for them.
You've probably heard that trading stock options is one of the fastest ways to make money in the markets.
That's reasonable and understandable. I don't blame them. These are high-risk investment methods that might result in the loss of your left arm and all your money under certain circumstances.
Shut up and take my money!
The chart in front of you is the first example of one of my favorite leveraged investing methods that I use myself. It shows outcomes for the same period as the examples. The return is calculated from a starting investment of $10,000 without dollar cost averaging. You can see the investment has grown to more than $13 million, with a high compound annual growth rate of 39% and a considerably improved drawdown over the strategies I previously demonstrated. This technique has a drawdown that is far lower than that of a buy and hold method with an S&P 500 index non-leveraged ETF like SPY, which has a 51% drawdown. With this degree of drawdown, it's simple to sleep at night. During a market downturn, you can see its robustness. This is a tried and true strategy that has stood the test of time. And here are the results for the double leveraged strategy, which simply adds $16.44 each day or $500 monthly to the portfolio. It beat all other strategy approaches I've shown you today on all metrics, with gains of over $38 million. It had a compound annual growth rate of 46%. Because of its greater return and lower drawdown, it's a lot simpler to manage, as you'd expect, making it one of my go-to strategy choices versus other high drawdown strategies I shared with you. As I've shown, some triple and double leveraged ETFs are quite successful at accomplishing their intended goals and working in certain situations. However, they're not for everyone. You must be aware of how these types of investments can behave. Otherwise, you may be in for a nasty surprise. You need to understand how they work, why they work, and the risks involved. If you have a chance to take advantage of the superior performance that triple or double leveraged ETFs can deliver, and have a proven strategy to limit those risks, then go for it. If you feel comfortable with them and you're very careful, these investing strategies can be very profitable. If you decide to use any of these methods, get expert advice from a qualified financial planner or advisor first. Read the prospectus fine print carefully before investing in any of these instruments. And click the link below to learn more about sophisticated market-beating methods that I frequently use, with returns as high as 50%. Good luck. Thanks for watching. We'll see you next time.
How about that? Pretty cool, huh? Yeah, I think you could do it in maybe M1 Finance or something like that. You could do the fractional stuff. Not exactly sure, but I thought this was really good, and I hope you are all kind of excited, right? Because there's a couple things that we have that he doesn't have too, right? So we've got the Black Swan hedge. So we've got the Black Swan hedge to help us during the the down crashes and everything, so that we won't face astronomical devastation, the huge drawdowns that they were seeing at certain times. And the other thing that we have is we've got the Licello spreadsheet that I developed that will tell us, hey, as you are making all this money, right? If we hadn't done a single options trade, y'all, this thing's already spit out $8,800 since October the 15th. I mean, it's phenomenal, right? Just phenomenal. And what it's telling us to do is, as this price continues to go up, it's telling us, hey, take some off the top, take risk off. So now we've got the regime change that we talked about, which is either the 200-day simple moving average or the 10-month simple moving average. Both of them are, choose which one you want to go with, right? I think from a couple things that I was reading over the weekend, the 10-month simple moving average is probably the one that I'm going to hold on to. So what does that look like? Let's see what that looks like. That looks like this, that. Let's see. No. Here, let's see. I think I did it over here. Load chart layout and 10-month SMA. 10-month SMA. And interestingly enough, you know, we were talking about, hey, do we run this on SPY? He actually ran it on the TQs, right? Choose your poison. Do it on TQQ. Then here you go. So the cool thing is you're not out of the market much either, are you? Look, you're out of the market, you know, when we're down here, you were here, but look, it's been all roses since then. So we've got a couple things that I think makes the entire strategy much better. We've got 1-1-1 trades that help us on grind down markets. We've got the Black Swan hedge that helps us on market crashes. And we've got the Lucello algorithm that the entire time is telling us to take off risk. And when price goes down, it's saying, hey, get back in, baby. I don't know what more we can do. Matt, you ought to be excited. Matt, can you talk or you at work now?
Yeah, I'm here.
Are you excited, Matt? I mean,
I am excited. I'm up $75 today.
He's up $75 today. Hey, you only put what, like 1,000 or so in, with a couple thousand or so in TQs, and the thing is, someone made the comment.
I put 1,500 in TQQQ.
Yeah.
And 500 in TMF.
And who was it? Was it Rod that did in chat said, let's see, said this, made this comment. The best management tool that you have is to forget your login information. That's it, right? I mean, if Matt really wanted to do TQQs, he needs to go, what does he need to do? He needs to put $16.44 in a day. He needs to be putting in, you know, the 500 or 200 or 100 or whatever dollar cost averaging into it every pay period, every month, whatever. Set your goal and do it. And I love what Rod said. Your best management tool is just forget your login. You know, automatically have your brokerage company debit your bank account every pay period for whatever, and then buy TQQ and dollar cost averaging. I don't know what else to say. I mean, my God, I'm speechless. You know, I just think that, you know, the video is a little cheesy at times, no doubt. You know, he's trying to sell courses and apparently get advertising money from this YouTube. That's fine. Hey, it's America, baby. Do whatever. But if you take what he was talking about and we implemented this, we implemented with Black Swan hedges and 1-1-1s and calendar spreads and the Lucello algorithm, dang, I mean, this is solid. So I'm really excited. Every day I go to bed at night and I go, my gosh, this is really, really exciting. So I'm glad y'all are on the journey with me. If you're not on the journey and you want to start, you know, just do it. Do it, like he said, a little bit of your money, 10% of your capital. You know, put something in it and let it work. All right, so I have one central meeting with somebody today, and I can't even remember who it is. Who is it? Anybody? Anybody here? I think it's 2 o'clock. So I will be back at 2 with them. Let's see what I get. Matt is 50% allocated. He's in, baby. He is in. And ours is probably a little bit safer too, right? Because here's what I did. You remember my setup was I went 72% TQQ, right? So I did that in the TQs. I did 18% TMF. So that's 90% TMF. F, Bobby, yeah, not 5. And then I went, 10% cash. I like a little bit of cash so I can change those into TQQ shares on down moves. So that was my allocation. What's your allocation? And you don't have to use the TQs. You can use UPRO. Or if you want to be a little more conservative, do the 2X, ETFs. You don't have to do right. I changed mine to 50-50 TQQ and TM with half of TMF being cash. There you go. Yeah, that's fine. It's great. And then it depends, are we going to use this market regime strategy on the, 10-month? I mean, this tells us when to be in and when to get out. If this price drops below here, what are we going to do? Well, I would say he showed that it was very much beneficial to get out of the TQs. So we'll get out of them if we get below that monthly simple moving average, and we'll go to all TMFs. All right. But then the cool thing is we won't tell our spreadsheet that we're out. So even during that, the spreadsheet will be saying, hey, buy some more shares. And we will. So we'll buy them, right? When that thing goes down, like if that thing went down to 100 now, let's just play with it. Let's go down to 100. Let's say TQs go to 100. We're going to buy 101 shares. What if this sucker goes down to 70? We're going to buy 249 shares. What if this thing drops all the way to 50? We're buying 445 shares. You see what this is, y'all? He didn't even have that in his plan. We've got it. We've got it. Well, I don't know how we make this any better. This is solid. So I'm real excited. Excited y'all are along for the ride too. So let's just do it. And if y'all need one-on-ones, let's set them up. Y'all have a good day. See you tomorrow.